Well, I wouldn't do anything nearly so noble as to withhold investing myself just so that Greg could look good later on.
There is one chart that has flashed red before every major market crash in modern American history: 1929, 2000, 2007, 2021. Everyone. As of May 2026, that chart just printed a number nobody has ever seen before: 228%. The chart is called the Buffett Indicator, named after Warren Buffett because in 2001, he wrote one sentence in a Fortune article that has become legendary. He said it is, quote, "probably the best single measure of where valuations stand at any given moment. The math is shockingly simple. You take the total market capitalization of every publicly traded U.S. company and divide it by annualized nominal gross domestic product. The numerator most analysts use is the F.T. Wilshire 5000 Total Market Index. Divide market cap by GDP. The output is a percentage, and that percentage tells you whether financial assets are reasonably tethered to the real economy or whether they have decoupled from reality. The historical average for this ratio, going back to 1970, is roughly 85%. Below 89% is significantly undervalued. 115 to 140% is fair value. 140 to 165 is modest overvaluation. Anything above 165% is significant overvaluation. As of this month, the Buffett Indicator is at approximately 228%. Guru Focus puts it at 225.9. Macro, micro, and long-term trends report 226.8. Current market valuation estimates 230%, roughly 2.4 standard deviations above the long-term trend. Advisor Perspectives, using Federal Reserve Z1 data, reports 232.6. Whichever source you choose, the answer is the same. The U.S. equity market is trading at roughly 3 times its historical mean valuation against the actual economy. And here is the part that will make your stomach drop. There is a modified version that adds the Federal Reserve's balance sheet to the denominator, arguing QE has expanded the monetary base so dramatically you have to add Fed assets in. Even with that highly accommodative adjustment, the modified Buffett Indicator is still at 186.6%, still significantly overvalued. There is no version of this math that makes today's market look reasonably priced. Every prior peak in American financial history is a graveyard. In September 1929, just before the Great Depression, the indicator stood at roughly 130%. The market then suffered an 89% peak-to-trough collapse. It took 25 years for stocks to recover to their 1929 nominal price. In November 1968, at the height of the Nifty 50 mania, the indicator hit 87.1%. The S&P 500 then fell roughly 50% in the 1973 to 1974 bear market, with individual Nifty 50 darlings dropping 70 to 90%. In March 2000, at the apex of the dot-com bubble, the indicator peaked between 136 and 159%. The S&P 500 fell 49%. The Nasdaq imploded 78%. Recovery took 7 years. In October 2007, the indicator peaked between 105 and 118%. Within 24 months, the S&P 500 had collapsed by 57%. Recovery took 5.5 years. Then in November 2021, the indicator hit 193%. The market entered a bear market the next year, drawing down 25% intraday and closing 2022 down 18.11%. And now today, 228%, higher than every prior peak. 70 points above the dot-com peak. There is no historical precedent for this reading. Buffett laid out the framework in that Fortune article. He said, if the ratio falls to 70 or 80%, buying stocks is likely to work very well for you. Then came the warning you have to internalize. Quote, if the ratio approaches 200%, as it did in 1999 and a part of 2000, you are playing with fire. Buffett's own threshold for playing with fire was 200%. Today's reading is 228. 28 points above the level he defined as the danger zone, and his behavior speaks for itself. Berkshire Hathaway has sold more stock than it has bought for 14 consecutive quarters. Its cash and treasury bill pile sits at a record $390 billion. Buffett told shareholders, quote, nothing looks compelling. The most disciplined capital allocator on earth is staring at the indicator that bears his name and refusing to deploy capital. This is where most viewers want to know what the math says about future returns. The answer is brutal. Valuations don't dictate short-term price action, but they operate as a strict boundary on long-term expected returns. A stock is a claim on future cash flows. The higher the price you pay today, the lower your rate of return. That is arithmetic. When the entire market trades at 228% of GDP, the gravity of that valuation pulls 10-year return expectations towards zero. Guru Focus's regression model implies an average annualized return of negative 0.7% over the next 8 years, even after the S&P 500's 1% dividend yield, negative, for 8 years. John Hussman, a PhD economist who has tracked this data for decades, runs an even more conservative version, the ratio of non-financial market cap to corporate gross value added. His preferred metric is now at the highest extreme in the entire history of U.S. financial markets. Higher than 1929, higher than 2000. Nominal GDP, S&P 500 revenues, and corporate gross value added have all grown at roughly 4.5% annually for decades. Add the current dividend yield of 1.2%, and the maximum structural nominal return is about 5.7%. The moment valuations mean revert, multiple contraction overwhelms growth, and total returns turn deeply negative. Hussman projects 10 to 12-year S&P 500 returns will be, quote, well below Treasury bill yields. Wall Street, structurally biased toward optimism because their business model depends on selling you equity exposure, is issuing some of the most muted long-term forecasts in history. Goldman Sachs's chief U.S. equity strategist projects 3% annualized nominal returns for the S&P 500 over the next decade. Vanguard bumped its 10-year forecast by 1 point, but said valuations are still significantly above long-term fair value. J.P. Morgan projects 6.7% annualized for U.S. large caps over the next 10 to 15 years, but only if AI drives broad-based margin expansion. Here is the honest counter-argument. The bulls have 4 pillars. First, U.S. GDP is the wrong denominator because multinationals earn enormous revenues overseas. Second, today's megacaps are capital-light, intangible-heavy monopolies with software margins that justify higher multiples than 1970s industrial firms. Third, the Fed model, the idea that low rates inherently support higher P/E ratios. Fourth, intangible assets, brand, data, algorithms are not captured by industrial-era metrics. All 4 have rebuttals. Hussman's gross value-added metric accounts for foreign revenues, and it is still at an all-time extreme. Profit margins are the most mean-reverting series in finance, currently at 15 to 16% versus historical averages near 8 to 10. The Fed model has weak correlation with actual returns, and rates have normalized higher without valuations contracting. And while moats may justify high present earnings, they don't guarantee infinite future growth. If the Buffett Indicator were the only red flag, you could maybe explain it away. But every adjacent metric is screaming the same warning. The Shiller cyclically adjusted P/E sits between 36 and 41. The long-term mean is 17. The 1929 peak was 32.6. The dot-com all-time high was 44.19. We are within 4 points of the dot-com peak. The forward P/E sits in the 96th percentile of all valuations going back to 1980. Tobin's Q ratio sits at 1.98. The market is pricing corporate America at nearly twice what it would cost to physically rebuild. The equity risk premium sits at 5.29%. Hussman's margin-adjusted CAPE still rivals the 1929 and 2000 peaks. Every gauge agrees. So what is causing this? The 2026 indicator is the output of 3 structural forces converging at once. First, concentration. Roughly 35% of the entire S&P 500 is now in just 7 companies: Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta, and Tesla. These megacaps trade at aggregate price-to-free cash flow ratios above 52 times. 60% of the entire U.S. market cap now sits in stocks trading above 35 times forward earnings. Second, the AI infrastructure spending boom. The top 5 U.S. hyperscalers are projected to spend roughly $700 billion on capex in 2026 alone. Goldman Sachs estimates total hyperscaler AI capex at $1.15 to $1.4 trillion from 2025 through 2027. The market has capitalized those projected expenditures as guaranteed future profits, exactly what happened with telecom in 1999. Third, passive investing. In March 2026, active funds saw $25.87 billion in net outflows, while passive index funds absorbed $74.03 billion in net inflows. Index funds buy blindly based on market cap weighting. The bigger Apple gets, the more every 401k dollar buys Apple. Add corporate buybacks like Apple's $185 billion 2025 repurchase program, and you have a constant price-insensitive bid. Now what about catalysts? Valuation alone is not a catalyst. An overvalued market can stay overvalued for years, but extreme valuations make the market acutely fragile. 3 fault lines in 2026. First, demographics. By 2030, 1 in 5 Americans will be 65 or older. The oldest baby boomers turn 80 this year. Required minimum distributions are mandatory at age 73. The U.S. retirement system is shifting from accumulation into decumulation. The structural buying force that supported markets for 40 years is reversing. Second, the AI capex ROI wall. Anthropic alone projects cash burn losses of $29 billion in 2026 and $66 billion in 2027. If the trillion-plus in hyperscaler spending fails to generate the trillions in enterprise software revenue required to justify it, the Magnificent Seven get repriced and the entire index unwinds. Third, debt and geopolitics. U.S. government debt is approaching $40 trillion. Geopolitical risks around Taiwan and the Strait of Hormuz could reignite inflation, forcing the Fed to reverse rate cuts, which would crush a market priced for cheap money. Here's the honest other side. Acting on macro warnings has historically punished investors who act too early. The Buffett Indicator has looked expensive for 15 years. JP Morgan's research shows missing just the 10 best trading days over a 20-year period cuts a portfolio's value by more than half. A fully invested 20-year portfolio worth $64,844 drops to $29,708 if you miss only the 10 best days. And those best days almost always cluster immediately after the worst days. So how do you reconcile the warning with the cost of being early? 3 things. First, do not interpret this as a signal to sell everything and go to cash. That is not what Berkshire is doing either. Berkshire still owns roughly $274 billion in equities. They are simply rebalanced toward defensive and cash. Second, understand your own concentration. If you are 100% in an S&P 500 index fund, you are heavily exposed to the AI capex trade through the Magnificent Seven. That is a position, not diversification. Third, build optionality. 3 to 6 months of expenses in a high-yield savings account or treasury ladder is the tool you use when, not if, the next dislocation arrives. The chart that called every major peak in modern history just hit a level with no precedent. That does not guarantee a crash next month. It guarantees that mathematically, your forward returns from this entry point are likely to be poor, and that the system is fragile. If you want to see what stocks the most disciplined capital allocators are quietly buying right now, while the indicator screams red, watch this video next and subscribe. Just a reminder, I'm not a financial advisor. This video is for educational purposes only, and any results depend on your own decisions and actions.